With the rising inflation, a good asset to have in your portfolio are REITs, which stands for Real Estate Investment Trusts. A good rule of thumb is to have about 10% of your retirement portfolio in REIT. And in today's video, I'm going to be going over 4 different REITs that you can add to your portfolio that will help with your dividend income. So let's get into it. And if you're here sharing stocks to help you on the investing journey. Before getting to the first REIT, I want to go over 2 things. The first is what funds from operation is. Now, you can look at funds from operation similar to what earnings per share is. And generally, earnings per share is what you look at on a common stock as far as some valuations and look at the PE value, which is price to earnings. Now, with REITs, you have to look at the funds from operation. And this is basically the cash flow coming from their operations. And I'll put up right here what the formula to calculate the funds for operation is. It is the net income plus the depreciation and loss of sales of assets minus the gains of sales of assets and the income interest. Now, like I said, you can view this similarly to earnings per share. However, it's not the same as free cash flow. And with this, we'll also use funds for operation to determine the payout ratio. Speaking of the payout ratio, is that REITs are required to pay around 90% of their taxable income to shareholders in the form of dividends. So they are going to have higher payout ratios than you may see in other stocks. So they generally would have around 60 to 90% of their payout ratio. With that said, we'll get into the first REIT, which is Agree Realty Corporation, ticker symbol ADC. Now, Agree Realty Corporation primarily engages in the acquisition and development of properties leased to industry-leading retail tenants. They have over 1,000 properties located in 45 states, and just to name a few is 24 Hour Fitness, 7-Eleven, Wawa, and PetSmart. For the start of the year, Agree Realty has grown 12%. The last 30 days, they have grown 5.31%. So I'll give you a current share price of $79.31. They're trading very close to their 52-week high, which was $80.50. And their current market cap is $6.34 billion with a price to funds for operation similar to price to earnings is 20.31. Looking here, we have the dividend yield, 3.44%. And annually, you will receive $2.81. Now, for the payout ratio, we are going to divide the dividends received by the funds for operation. So we'll take $2.81 divided by the funds for operation, which right over here is 3.90. And that'll roughly give you about 72% as a payout ratio. Now, over on the income statement, just looking at the revenue, we can see that year over year, Agree Realty has been steadily increasing their revenue, which is great to see. And scroll down here to their net income, we can see that they are also increasing their profit year over year. So you can see right here with the current $128 million. Once more, we're going down, and generally I look at the shares outstanding and we would like to see them decrease. However, for REITs, you generally will see the shares increasing because that means that the company is acquiring new real estate and growing their business. So it's not a bad thing to see that the shares outstandings are growing. One other thing I want to look at is their dividend per share to see if it's growing every single year. So you can see here we have 5 years ago it was $2.05, and of course we looked at earlier it's $2.81. So every year it's been growing steadily. So that's good to see as well. Over on the cash flow, we're going to scroll down right here for the free cash flow, and you can see just like their revenue and net income, it has been growing year over year. So that's a good sign. And the 5-year average is $147 million. So great to see here. Over in their balance sheet, we're just going to get a comparison of how many assets they have compared to their liabilities. So right down here, we have total current assets of $85 million. And the current liabilities right now is $81 million. So that's a good sign to see that they have more current assets than they do liabilities, because we don't want to have a company that's too far into debt that they can't manage if something goes wrong. So you want to kind of pay attention to that. Now, right now I'm over in Alpha Spread, and we're going to be looking at Wall Street price targets. So right down here, they have low of $75, which is about 4% lower than the current share price, with the average of $82.78. Going down here, I have the revenue forecast. So we're just kind of taking a general idea of what some analysts see. And right here, the average for the next 3 years is about 21% as far as revenue growth. So I'm going to go over to Stock Analyzer to put in some of my assumptions and see if the current share price of $79 is a fair value. So taking the 21% that we saw in alpha spread, I kind of want to put that more of as a high value and just be conservative. So right here you can see I have 12, 14, and 16 as far as revenue growth. And then we have profit margin, just kind of keeping in line with the historical data here. So 25, 29, and 33. For free cash flow, we have 62, 64, and 68. Those with historical values here. And then PE, I just stuck in 14, 16, and 18, but we're not really going to look at PE because, like I said, more concerned with price to funds for operation. And then, of course, for price to free cash flow, I just put 14, 16, and 18 as a general value. And for REITs, I'm going to be looking for a return value of 12%. So scrolling right down here, see that the current share price is about in between right here. So I do see it as a fair value. We're looking at the low mid-range, so I think around $70 to $80 is a fair value for Agree Realty. Last thing I'm looking at for here, just going over what Seeking Alpha views as the dividend safety and dividend growth. They give the dividend safety a B+ and dividend growth a B-, as well as the dividend tracker also gives a dividend safety score of 55. Second REIT I'm going over is Alpine Income Property Trust, ticker symbol PINE. Now, Alpine Income Property Trust, they acquire, own, and operate a portfolio of high quality single tenant commercial income properties. And they basically grow their revenue that's derived from properties that they own and also lease. For the start of the year, Alpine has fallen 11.45%, and for the last month, they have grown 1.44%. So I'll bring them to a current share price of $18.26. Looking over here, they're fairly close to their 52-week low, which was $16.75. Right down here, the current market cap is $247 million, and the price to funds for operation is 10.88. We have a dividend yield of 5.83%. with the annual payout of $1.08. And looking at the payout ratio, we'll divide that by the funds for operation, which is $1.68. So I'll roughly give you 64.3%. Over on the income statement, we're looking at the revenue. And for Alpine, they haven't been around that long. As you can see right here, it's about 4 years. So just looking at the last 4 years, they have grown exceptionally the last 4 years. So from $6 million, and right now they're at $35 million. So they have been growing. Scrolling down here, we have the net income. So just like their revenue growth, the last 4 years, they have also grown their profit. Once more, scrolling down here, looking at its shares from operation. And once again, they are going to be growing. The shares are going to be increasing because the company is growing here. And for the dividend shares, they have been growing those as well. So we have from 20 cents, and right now the current is $1.08. So they have been growing that, which is a good sign too. Not so much a big increase the last year from $1.04 to $1.08, but from what they started in 20 cents, and they have a good path forward. So over on the cash flow, just looking on here for their free cash flow, they have been steadily growing that as well. Not too much history, but we have seen that they're moving in the right direction. So right now we have a current value of $19 million from last year of $10 million. So that's good to see they're continually growing. Over on the balance sheet, we're just going to be looking at the current assets compared to our current liabilities. So you can see here the current assets, $6.5 million. Going down here to the current liabilities is $3.6 million. So they have about double the amount of current liabilities. So that's a good sign that they're not drowning in debt, especially as a new company, they have room to grow. Looking at some Wall Street analysts' price targets, we have their low is $19.19, so that's about 5% higher than the current share price, and their average is $22.24. So based on the Wall Street analysts, Alpine is looking at a good value right now. However, we're going to scroll down to see what the analysts view as what analysts see as the revenue forecast, and then I'll move over to what my personal assumptions are. So looking right down here, they are seeing in the next 3 years about 30% revenue growth. So I felt that the 30% was a little too extreme. So I just went with my assumptions of 10, 12, and 14. I think that's more of a reasonable assumption as far as growth in the next 10 years. I have right here the profit margin. Want to keep it close to what they are aligned right here. So I just put 22 through 28. And then the same with free cash flow, around 42 to 50. So still in that range, but being a little conservative. Once again, I'm not really concerned with PE and the price of free cash flow. Once again, I'm keeping the same from 14, 16, 18, and also 12% return. Right in here, looking at the calculations, we have, looks pretty bright for Alpine, and I'm really considering more in the $20 range. So right here, my low and mid assumptions, it looks like that Alpine, according to these values, are showing that it is trading currently at a fair value. And for Alpine's dividend grades, they have a dividend safety of B- and dividend growth of B. Dividend tracker gives it a value of 67 out of 100. If you've been enjoying and find value in this content, let me know by smashing the like button. And while you're down there, drop a comment if you have any of these REITs in your portfolio, or if you have any favorite REITs, let me know down below. Remember, I'm not a financial advisor, so be sure to do your own due diligence before investing in any of these REITs. Next REIT I'm going over is Regency Centers Corporation, ticker symbol REG. Now, Regency Center primarily are the owners, operators, and developers of shopping centers located in high populated areas. These centers would include groceries, restaurants, service providers, and realtors that are connected to the neighborhood communities and customers in the area. From the start of year, Regency Centers has fallen about 15%, but within the last month, it has grown 5.16%, bringing them to a current share price of $64.81. Right over here, they are below their midpoint, so they are close to their 52-week low, which was $55.78. And right down here, they have a current market cap of $11 billion with a price to funds from operation of 16.49. They have a dividend yield of 3.78%, which will give you $2.45 annually. Now, dividing that by their funds for operation, which is 3.93, that'll give you a payout ratio of 62.34%. Now, over on the revenue, we have a lot more data here than with Alpine. You can see that they have been slightly growing the last few years. They're moving in the right direction. So about 5 years ago it was 1 billion, and coming up here we have 1.2 billion. Scrolling down here to this net income, they have also been growing their net income from about 250 million. So now they're at 475 million. Going down once more to the shares outstanding, you can see that they have been growing. So that's a good sign for REITs. They're obtaining more properties. So from about 5 years ago, they had a little dip there, and ever since been growing back to a current share number of 171 million shares. As far as their dividend per share, they have been growing that steadily over the years, which is good to see that they're continually to grow consistently. And now moving on to free cash flow. Right on here for the free cash flow, they have been steadily increasing that as well. There's a little dip here in 2021, but they have made it back, so they're increasing from the 2020. There's a good sign, and they'll have a 5-year average of $594 million. Over on the balance sheet, looking at their current assets, they have $332 million. And right down here, going to the current liabilities, $278 million. So they also have more assets and liabilities, which is a good sign. Looking at Wall Street price targets, we do see that their low price target is $56.56. So that's about 12% lower than the current share price, with the medium of $70.44. Looking at the revenue forecast that analysts look at, they are looking at, for the next 3 years, about an average of 4%. Now, for my calculations, I'm going to use like a high of 8% right here, just as a basis for what I'm calculating. So let's jump over to the stock analyzer. So right here, I'll have my low as at 4%, and then my high as the 8% that they viewed for 2024. Profit margin, I'm keeping it close to that 10-year, so the 23%. And then also for their free cash flow, kind of keeping it underneath their 10-year 52%. Once again, we're not really concerned with price to earnings, but looking at price to free cash flow, I'm going once again from 14, 16, and 18, and then 12% return. So with those calculations right down here, we can see that according to my high assumptions, Regency Center is looking at a great buy. I'm looking more as the mid-range. So it is fairly close. It's in between the mid and high. I would see it as a fair value right now. I do have a desired annual return of 12%. So depending on what annual return you are looking at, it could be right in your ballpark. But I think we're in a fair value range right here. It's not too overpriced based on these assumptions and what analysts are seeing as revenue growth in the next few years. So that's a good sign as well. Now for Seeking Alpha's dividend grades, they have a dividend safety of A- and dividend growth of B+. And Dividend Tracker gives a dividend safety of 47. Next we have Medical Property Trust, ticker symbol MPW. And Medical Properties, they acquire and develop net lease hospital facilities. They have grown to be one of the world's largest owners of hospitals with over 400 facilities in 9 different countries across 4 continents. And they basically funds facilities, improve them, technology upgrades, and other investments into those hospitals. Now, from the start of the year, Medical Properties has fallen about 32%. And within this last month, they have pretty much been stagnant, which could be a good thing or a bad thing depending on how you see it. But that'll bring them to a current share price of $15.95. They are very close to their 52-week low, which was $14.11, and their current market cap is $9.5 billion. They have a price to funds for operation of 8.75 with a dividend yield of 7.15%, which will give you $1.16 annually. Dividing that by their funds for operation of $1.82, that'll give you a payout ratio of 63.73%. Looking at its revenue, they have been slowly growing it the last couple of years. They were in the high millions and now they're in $1.59 billion. So that's a good sign. Scroll down here to their net income. Along with their increase of revenue, they have been steadily increasing their profit as well. So they had about low millions and right now they're at $1.12 billion. Scrolling down once more, they have been steadily acquiring different properties. So they had about 364 million shares and now they have almost 600 million shares. And every year they have been increasing their dividend nicely as well, which is a good sign to see some growth there as far as us dividend investors. For the free cash flow, scrolling down right here, we do see that they have steadily been growing their free cash flow. Now lastly, looking at the budget sheet just to see if they have what their ratio of assets to liabilities. You can see right here, their current assets is $1.04 billion and their current liabilities is $1.15 billion. So they're slightly above their current assets, but not too far off. So something to keep looking at, but they are going to continually growing and need to acquire new hospitals to stay one of the top ones in the world. Now, as far as Wall Street analysts, they see a low price target of $15.15, which is right in line where the current share price is of pretty much $16. And then you see an average of $20. Right in here, looking at the revenue forecast. So analysts are seeing around that 8% growth, average 8% growth for the next 3 years. So I'm gonna pretty much be looking right here for my calculations between that 4 and 10%. For over here at that 4-10% I just mentioned, I'll be keeping profit margin lower than their 10-year average. So the highest is 52. The same with their free cash flow margin, keeping it underneath that 52% of the 10-year. Once again, not looking at price to earnings, and I'm keeping a little lower of my price to free cash flow than I did in the other 3. So I'm going from 10, 12, and 14. And once again with a 12% return. So looking right down here, we can see that the current share price is pretty much in between my low and mid. So that's a good sign. It's pretty much right in the middle right there. So I do see Medical Properties as being at a fair value at this time based on those assumptions. And as far as dividend grade, they have a dividend safety grade of B- and a dividend growth of C+. And Dividend Tracker gives them a value of 70 out of 100. Once again, if you have any other favorite REITs, let me know down in the comments. And if you're looking for more REITs to add to your portfolio, definitely check out this video and I'll see you over there.